I'm Rob Kingsbury. I'm here today with Ian Lowes, founder of CompareStructuredProducts.com and the Managing Director of Independent Financial Advisors, Lowes Financial Management. Now, as an investor, one of the things that interests me about structured products is the element of capital protection that they can provide various levels of. What protection of capital can I get from a structured product?
Okay, start at the beginning. A structured deposit up to £85,000, potentially subject to financial services compensation scheme. That's your only real total protection. Once you get into the capital at risk or get over those limits, then you are exposing your capital to risk. Now, structured capital at risk products might give you a degree of protection against the market falling by anything up to a significant amount over the investment term. So you might be exposed to rises in the market, but not exposed to falls in the market unless the market falls by, say, more than 50%. Let's talk about the FTSE 100 index. Now, the FTSE 100 index hasn't fallen by 50% over a 5-year period, even the tech boom collapse or the banking crisis, but that doesn't mean it's impossible. So therefore, this protection is against all but the catastrophic fall in the market. If it falls over 50%, well, you have to accept that you've taken the risk and that you are going to suffer a loss as a result. Now, that 50% fall could have been 40%, could have been 30%, and you have these different barrier levels. Obviously, the closer the barrier is to the starting level of the index, the greater the risk, and that should translate to a greater potential return than something that's got a bigger barrier.
With capital at risk products, I've heard of the terms American barrier and European barrier. What do they mean?
Technical terms. We refer to a European barrier as an end-of-term only barrier. That's something where the capital is not risk from market movements unless the, let's call it the FTSE 100 index, has fallen by more than, say, 50%. That's my barrier level at the end of the term. So it's observed right at the end of the term. If the market is below the barrier, then I suffer a capital loss. An American barrier is an intra-term barrier. That means that the barrier can be breached at any day or any week or month, depending on the terms of the contract, during the term. So you might have a situation where, let's just say the FTSE starts off at this level, it falls by 50% during the term, and then ends up 40% down at the end. An intra-term barrier contract might give rise, therefore, to a 40% loss, but an end-of-term only barrier, one with a European barrier, would give rise to no loss if that was a 50% barrier, because it's not below that 50% at the end of the term.
Okay. So if I'm an investor, should I go for the end-of-term barrier rather than the intraday barrier, which would quite clearly offers more risk to me?
If you have two contracts and they're identical except for that, then yes, go for the end-of-term barrier, because obviously the chances of the FTSE being down by 50% or whatever the barrier level is at the end of the term is less than the chances of it breaking through that barrier throughout the term, particularly at the early stage. So in isolation, you'll always opt for the end-of-term barrier, but by opting for the end-of-term barrier, you're taking lower risk than you would do with an intra-term barrier, and as a result, you've got lower potential return. So you might want to use a combination of both of them, or it might be that it's worth the potential return that you're getting for accepting the risk of that intra-term barrier is very much giving you a high degree of pickup in terms of your potential return. So again, there is no straight answer, but yes, you would rather take no risk and get maximum return, wouldn't you?
We all would. Thanks very much, Ian.